Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
Welcome to the Mutiny Investing Podcast. I'm Jason Buck from Mutiny Funds, and my special guest today is Zed Francis from Convexitas, coming at us all the way from Chicago. How's Chicago treating you today, Zed?
It's actually pretty miserable outside my window. We had a pretty nice March, but man, April's been not good.
I'll have to send you this thing I saw the other day. It was like the 13 seasons of Chicago, and they're all like second winter, third winter, pollen season. Like it had like, and then summer was like just a blip on the radar, right?
Yeah, I mean, ultimately, the last, decade of, we'll call it seasonal shifts that are going on everywhere in the world, the main thing that's happened here is this spring has gotten worse and worse and worse, but the fall's gotten longer and longer. So it's like last, third week of December, I was playing golf with my dad in shorts and short sleeves. It was like 72 degrees. So it's like, it's just shifting. So you're like, mentally, you're like, I'm broken by March. And the answer is no. Now that's like May and you're completely broken.
But also we're recording this on April 20th, but didn't you guys also have like snow last week? Did I see that as well from some of my friends? Like just a crazy random snowfall?
Thankfully, mix of both my house and the office are close enough to the lake, and so that shielded us from actual snow happening. But yeah, 10 miles away from the lake. Yeah, they got more than a dusting, I heard.
That's crazy. But for those of you international listeners, if you've never been to Chicago, one, highly recommend it, but also highly recommend going in the summertime because nobody does summer better than Chicago. I mean, the outdoor cafes, but more importantly, the rooftop patios. It's unlike any other city in the world, I think, for the amount of rooftop balconies and everything that get used for those few months of summertime. It's quite extraordinary to see.
My wife is Irish. Her whole family is still over in Ireland, and the in-laws have been in town for almost 3 weeks now. And they do it because my wife's mom, Jeanette, is a teacher. So they get, call it spring break plus Easter break. And then she took a week off or whatever. So we worked on the calendar. And I tell them every year, I'm like, guys, this is not the time to come. I get it works well with the teaching calendar. But like, wait for the summer vacation. They're like, oh, but we go to France and this and that. I think this one finally broke them. They've been here long enough, and they're like, okay, like there's no reprieve, and we're all trapped in the house and getting sick of each other. So I think I finally moved their annual trip from April to June.
Man, I think last time I was in Chicago was October, November. And, I'm just a romantic. So every time I travel, I'm like, man, I could live here. And I start imagining what it'd be like to live there. And I was saying, man, I could really live in Chicago. And then I turned the corner and caught the wind off the lake. And I was like, nope, can't do it. Cannot do it.
Way too soft with your Northern California lifestyle.
Exactly. But as you know, I grew up in Michigan, not too far from Chicago, but obviously, I left when I was 15. So yeah, I can't do winters anymore. So let's obviously transition, talk about markets a little bit. But what I want to bring up maybe to start with is you recently wrote an essay on your website, and I love your website. It's just convexitas.com, just to make sure it's correct. Great. And then the essay was called The Storm Provides. So maybe if you want to kind of give a synopsis and we can kind of go from there and what you're referencing with The Storm Provides.
No, I mean, essay is way too strong of it makes it feel like you're setting up for like a white paper or something. It was a simple post. It's essentially the impetus of it is Harley Bassman was bothering my business partner, Devin Anderson, about why basically the curve was shifting so dramatically. Just call it, we had a month there where 2s, 10s, steepening, flattening really aggressively and seemed out of whack, especially in comparison to all other things that were happening in the market over that time period. And Harley had a thesis that it was related to some structured note product that was out there, residual things like stuff issued, call it from 2009 through 2012. So I asked Harley to just send me a couple of the prospectuses of these structured notes so I can digest what the heck he was talking about and make my own view. But if anybody's actually gone through, especially the details of those structured note prospectuses, they're not exactly fun. And I printed out about, I don't know, 5 or 6 of them to make sure I have a broad view of what he was talking about. And I went to a little local pub near my house called Estelle's with an old fashioned as the best means of understanding all the fundamental details of these notes. The notes themselves were way less interesting than even I thought possible, and ultimately didn't think that they were as market movie as potentially intended. But what happened at that pub is it was the first day where we'll call it headline reported 30-year mortgage rates were above 5%. And at this pub, there was, 2 guys that just got off a construction shift, probably in their 40s. There are 2 guys that were probably, 22 years old, living in some cheap apartment down the street and, starving artist in Wicker Park or something like that. The bartender and the fry cook. And while I was enjoying my old fashioned and not enjoying reading these structured note prospectuses, I overheard separately, and all those folks, they mentioned how aggressive mortgage rates have gotten. All of them were like, I can't believe 5%. And so it kind of woke me up to like, is this finally the number that people start caring about? I mean, rates obviously for a good couple months here have been pretty aggressively, selling off. Bonds have been selling off. Rates have been going higher. But these very different folks from the financial services industry all of a sudden got onto their radar. So that put it in the back of my mind. And then the following morning, my new daughter happened to wake me up at about 3 a.m. So after feeding her, that provided me with some time to go ahead and think about how to produce that experience into a simple post. And that's what you mentioned, Storm provides. Ultimately, the theme of it is everybody, anytime we've had any sort of sneeze in markets and risk assets falling pretty much over our whole careers, people focus on why and when to buy the dip, if you will. Like, we had, obviously the somewhat surprise invasion of Ukraine. And if you heard everybody talking about it, they were like, this past, terrorist event, war, XYZ, geopolitical, how many days does it take to get back to, where you were prior to the event taking place? So nobody was like, things have fundamentally changed. Like, this is problematic. It's, if you buy the dip, how long should it take for you to get, all the way back to where you were, and how much money could you possibly make? That's been the general theme. And in my view, the reason for that over the last kind of 40 plus years, i.e. most people's investing careers, is that concept of the storm provides. So nasty things happen, the storm, but we have mechanisms, mix of monetary, fiscal, maybe just, communicative of we might be there to help, right? And maybe they don't actually do anything, but they might be there to help. That causes asset prices to appreciate quite quickly back to where they were, and maybe even surpass where they were previously. And obviously COVID is a great example of that, right? You have a distressed environment, they shoot crazy bazookas out of every possible outlet they possibly can, and not only do we fully recover quickly, we rally another 30% beyond previous all-time highs. And so the backstop of that is the of the storm provides is that concept that we've been trained that when really nasty things happen, we get all this support, which then provides the ability for asset prices to greatly appreciate. And the question, of course, is that going to be the experience over the next 10 years or not? And everybody can argue back and forth. I'm not necessarily saying it's over by any means. I'm just saying when you're starting from a place of extreme accommodation with pretty significant inflation, the snapshot reaction to provide benefits is probably a little more difficult for both monetary and fiscal powers out there than it is otherwise. But that's we'll call it the quick version of how we got to a post, Jason, not a white paper or an essay.
There you go. A screed written down from thoughts from old fashioned and great fried food. Maybe that's a better example. That I technically get a lot of those from you in text form. So it's nice to see it in what we'll call a thought piece form. So there's so many things I want to pull out of there that you said. One, I was just thinking about the structured notes. There's got to be some like Michael Burry out there, right? Like that he was pulling on all the CDOs and looking into what were the shittiest versions. Like somebody's got to be out there reading all those structured notes. Like you said, they're so boring. But I wonder who's like finding all of like the worst of combos or whatever and the vintages they're struck at. But there's got to be somebody out there trying to like figure out all that structured product market that's bored to tears reading those all day long. And so maybe that's not you now. After reading a few of them, you're like, this is pointless.
Well, I've read tens of thousands over my career. I do think there's valuable information in them, but you got to definitely filter because there's only valuable information in 1% of them. Maybe you got to find the 1%.
And I think you were hinting at it is like you're in an environment of TINA or BTFD, buy the fucking dip, all that thing. And that's the storm provides, like you were referencing. And like you were referencing as well, is like even during the start of the Ukrainian invasion is like how many things we saw on Twitter and FinTwit and other posts where people are showing the historical invasions and how the stock market rallied from there. And like as part of that, and I was just watching, Kathy Wood at ARK the other day in Miami was readjusting her future projections right after ARK just went through a massive drawdown. Now she's her future expectations are even higher for the fund. And so do you think that's just
she didn't just projections? She kept them exactly the same. It's just your starting place is lower, so the percent is higher.
Exactly. To recover, she just raised the percentage by 10 points to hit that recovery over the next few years. But I wonder, like you're saying, is like, do you think that's what we've conditioned that TINA BTFD over the last decade? And I'm probably, leading the witness here. And that's why, and then everybody's just stretching, looking for better data to show this is a better time to buy the dip. And like that structure is just still, rampantly in place. This is what people want. And so once again, we're always looking for confirmation bias.
Yeah, and I mean, behaviorally, obviously, we've been very well trained, and thus to break it is difficult, right? They've been trained for something for generation plus. To expect anything different is hard for folks to digest or even think is possible. The only thing that breaks these types of situation are forced events. Anytime you end up in a situation where you don't have the choice to either put more capital to work or hold on because things are going to get better at some point in time, it's when you're actually forced to go the other way. When there's any sort of forced liquidation type events, that's what breaks that construct of that focus of how long is it going to take to recover. It's like, it doesn't matter. I need cash, right? And we're pretty well levered as a society. So there's landmines out there to create those forced unwind type events. But we obviously haven't seen it yet. But you never know exactly what the cause of it is. Because if you knew, then it'd be easy to avoid.
Yeah, I can't. I just got asked on a panel too, like, what's the next Black Swan event? And I'm like, by definition, I don't know. But everybody wants you to define it so they could take advantage of it. But one of the little pieces that you had in there too is a chart that showed, like, I think it was the average American wealth, and it was from 2017, but it was like, it was a little surprising, not necessarily, but it showed that the average wealth it was equal amounts held in the stock market or investing portfolio as was held in their homes and their home equity. And I think probably since 2017, from 2017 to now, it's probably even more equal. So I was wondering, like, thinking about the amount of wealth that's held in housing, because like you said, we're all talking about the market, when to buy the dip in the market. Everybody always every form of news punditry and everything is all about the market, when like you're referencing is, most of people's wealth now is probably held in their home. And now we're seeing rates, over 5% on a 30-year. And then I was trying to look up the other day, I was trying to find good data on it about like equity lines of credits, not necessarily just refinances, but like equity cash out refinances, taking out the equity in their home. And it was in 2021, there was 250 billion. And I think since COVID, I'm trying to find good data on it, but almost $500 billion of equity cash outs. And we're running Q4 last year and Q1 and this year is the highest rates of like HELOCs and equity cash out refinance. And I wonder if that's kind of what you're hinting at or something that you're also looking at.
Yeah, so the first part, unsurprisingly, housing is a significant portion of household net worth, right? Super benign. U.S. equity market is about 50 trillion. U.S. fixed income market is about 50 trillion, and U.S. housing market is about 50 trillion. It's about a third, and those are the very boring basic asset classes. People would hold equities, bonds, and their house. And as you go beyond, we'll call it, the top 10%, the other 90% of folks, they're predominantly their house, right? And it's like that is their main asset. And so ultimately, even though it's we'll call a third of total assets in the U.S., it's probably the more important one because it's the one that the consumers actually hold. It's not just the rich guys. This is the people that are actually buying things and making the economy run. That's their most important asset class is their home. And so, do I necessarily think that they're aggressively tapping their home equity line, to invest other places? I think it's probably more the higher end of folks, to be frank. Like I know many we'll call it finance person that's just basically viewing it as a structuring conversation of, hey, I can borrow termed out debt at, not now, but a year and a half ago at like 3%. And take $500,000 out of my home for no taxes, like it's a no-brainer. And like that's just a structuring decision. Now, whether they went and bought equities with it or whatever they did, they're probably adding significant leverage to their lifestyle. But the more important one is just in general, the average consumer in the U.S. has their wealth tied up in their house. Housing prices going up in theory would be a benefit to the consumer. They feel like their wealth is increasing. The issue is we start getting to the point where the cash flow situation trumps the kind of, we'll call it net worth appreciation scenario. And what I mean by that is, really simplistically, if you had a house, in 2019 and now it's worth 20% more than what it was in 2019. That's about the national average. Obviously, certain places are up more than that and certain less, but 20% the national average. What does that mean for you? That means that your real estate tax bill is probably up about 20% as assessments are coming through. That's a negative cash flow effect, even though your asset may be worth more, like that's coming out of your paycheck, if you will. And home maintenance is a 1-3% of house value expense, and to say that that's up 20% in the last 3 years is probably an underestimate. We all know how difficult it is to get anything with your house fixed, built. Even finding a skilled contractor to be able to perform that service. So ultimately, if you had a $500,000 house and it's now worth $600,000, it may make you feel good, but you're probably sending out the door a significant amount more cash every single month, quarter to the tax man and general maintenance. And so we'll call it stimulus that was provided by the acceleration of housing values and people potentially taking money out of their house via refi or HELOC or so on and so forth. That was very substantial in 2020, 2021, without a doubt. But now we're probably experiencing the other side of that, which is money's going out the door for continued maintenance and or the tax man. And, I can tell you in Chicago, the tax man always cometh. Like, our assessment was like 40% higher than when we bought the darn thing and contesting it, and best of luck. But yeah, no, it's a difficult asset, especially when it's, for 90% of folks, the largest asset in their portfolio, because most people think of assets as positive carry assets, and housing is not that.
How dare you say that? You're saying something so sacrilege. So I've been around real estate my whole life, from commercial real estate to residential flippers. And one thing I do know is I've always brought up is like, they don't actually do the math of what their bottom line is, right? Everybody's like, well, I bought this house for $500,000. I flipped it for $700,000. I made $200,000. It's always like, wait, not so fast. And you have to actually go into their actual costs, and nobody really line items it. And so to put a finer point on what you were saying in the article is, like you said, I think that on average, it was like if they locked in the lower rates, they saved about $500 a month on average. But then the inflation of the home prices with taxes and maintenance basically ate up that entire $500. But as you and I both know, everybody thinks they're paying $500 a month lower because, like I said, once again, people don't necessarily do the math and think about all of their implicit costs. Like, I mean, I'm sure it's probably single-digit percentage of people that actually set aside 1 to 3% of the house's value for maintenance every year. I mean, I know you think about that differently, but I'm sure like a lot of people aren't necessarily doing that. And that was it. That was what I thought was an interesting piece of that discussion, is actually breaking out homeowners' costs. Because like that's the other thing, when people flip or they talk about the value of their house, not only do they not subtract the maintenance and financing costs over time, they also don't, extract the realtor costs, the closing costs, the taxes, et cetera. And once again, those percentages of these massive flips that we always hear about actually come down to like single digit percentage returns on an IRR basis over the longer term.
Yeah, the only reason it's interesting from an investing standpoint is the leverage you can accumulate.
Exactly.
And as an individual, without a doubt, it's heavily subsidized for the government. It's ridiculous to lend to an individual for 30 years money at, frankly, probably anything less than like 8%. Like that. Like if it was a free market with no subsidies, that's probably where stuff would clear. If only 20 cents down, like equity markets, you can only do 2x. Housing, you're going 4x. You're like max leverage, termed out financing, really low rates. It's heavily subsidized, and that's the only reason why it really kind of usually ever makes sense.
Yeah, like you said, it's the leverage, it's the forced saving plans, and then that assumes though that then somebody pays it down over like 30 years or 15 years, where the average time in house now has come down. I think it's down to 6 years. Last time I checked, it was 7 to 8 years, and I think it's down to 6 years. So the idea that like it's that forced saving plan, you're actually just paying interest even if you have a fully amortized mortgage.
Oh yeah, you went down with 20 cents. 6 years later, you got 26 cents. Great. So you're really hoping that the asset value of the 74 cents you're still borrowing just went up a bunch. Like that's the hope.
And then I think about, I'm curious, do you have thoughts on this? I'm going to venture us out way into speculation territory here. And I wonder if I'm just, I'm surrounded by what I see here in Northern California or other markets I look at like South Florida, is you're just seeing a ton of cash purchases. And one of the anecdotes I read is that a lot of boomers that like say have a house in the Northeast and are looking to move to Florida because they financed that house a few years ago at like 2.5% on a 30-year. They're like, why should I sell this house? I'll just buy the one in Florida because this one up north is costing me nothing. So now they're buying second and third homes, but they're not selling their original home. And sometimes they're not even renting it out because the financing costs are so low, they just don't care. And all their other asset classes have gone up over the last 10 years. That's pure speculation, but I'm curious your thoughts on it.
Yeah, I wouldn't be surprised if there's we'll call it accelerated snowbird effect going on with a mix of everybody feeling wealthy and people not wanting to live in their northern cities because they've decayed a little bit over the last 2.5 years. But
that's contracting supply too, though. If they're not selling their original house, right? That's also part of that supply contraction.
Yeah, but I think the more interesting bit is the concept of all cash offers.
Yeah,
I think that likely is a pretty big fallacy. That's not borrowed money. It's just different kind of borrowed money.
Right.
And, the borrowed money that I think is buying those homes and those all cash offers is, I got $3 million in S&P 500 in my Morgan Stanley account. And my advisor just said like, you can take out $1 million cash at Fed funds plus 75 basis points. And you're like, geez, that seems like nothing. Yeah. That's like 1.25%. Like I can go buy this house and just be like, I got $1 million cash. Like, and I can make sure I get it. And, in theory, what you're supposed to do at that point in time is you buy the house, as soon as it clears and you move in, then you're supposed to term out that debt, right? Now you're like, okay, like I use this as like a bridge. Now I'm going to go ahead and refinance it into a 7-1 ARM 3-year fix, whatever the heck that is. But my gut is a lot of people didn't do that simply because the headline interest rate of now, was 3.5, 4, now 5, whatever the heck it is a lot higher than your Fed funds plus 75 basis points. So you're really, you're creating the classic issue of a liquidity trap of, your debts are all short term and your assets are all liquid and long term. And the carry trade is awesome when it works. In 9 out of 10 years, 9 out of 10 years it works. And so it's pretty easy to get sucked into it. But that 10th year where it doesn't work, that's when you start having these illiquidity crises and forced unwind type events.
No, that's great. And I think Mike Green's talking about privately, I'm not sure publicly yet, about the idea too of, like you just said, is like, it's all about collateral these days. And, especially on the lending side, and the boomers are the ones that have the collateral that they can borrow against. And if you're a millennial or Gen Z trying to buy like that first home, it doesn't really, they're not even financing loans, no matter like what you can put down. It's much more that collateral. And so, and interestingly, I think that they raised Fannie and Freddie or conventional loans up to like 750,000, I think now. But like a lot of millennials or Gen Z, if they're trying to move to Chicago, Northern California, Florida, like that's out of their price range. So they need unconventional loans, and nobody's willing to lend to them, it seems like. But they are willing to lend against collateral, like you said, that then the boomers are using to buy the house and hopefully reterm that debt. But I wonder if that's part of it too, is just like the structure of lending is kind of changed, and now we're almost getting into money velocity and what the banks are really willing to create sui generis.
Yeah, I mean, not like this is anything new, but it's easy to get money when you have money, and it's really hard to get money when you don't. Like, it's like that's financialization of the world. Like that's the end result you end up with. But yeah, to me, the always the most interesting is mismatch tenors of assets and liabilities, and one of those being hyper liquid and one of them being illiquid, because that's what just sets up the potential unwind events. And by no means do I think I have any clue of which one of these landmines is the one that creates the big issue in markets. But what's what I like to keep track of is how many landmines do I think are out there, right? And so the odds higher or lower that one little sneeze can create a cascading event, or do I think everything, there's not enough landmines out there, so you'll be able to snuff out things after the second domino without having them fall to the third. And where I think we're at probably right now is there's a lot of landmines in comparison to historical conditions, if you will. And there was a lot of landmines out there in 2019, and I think COVID was a way to cover up a lot of the actual problems that were happening underneath, and allowed everybody to use the aggressive support because it was under the guise of this is for everybody, right? This isn't just a we'll call it financial crisis 2.0 type event where we're bailing out the people that are tough for the average citizen to stomach, right? You're like, if it's COVID, like it's for everybody, and it's easy to go ahead and start cutting those checks. And what took place from 2020 2021 was, of course, we didn't solve any of our problems. Nobody ever does that. We just paper over them. So they're all still there. And we probably added a few more along the way, right? So it's like, I think we're in that situation where, because we never hit the full reset button, we didn't cleanse the system of the problems that were already baked in. We really just aggressively papered over them. And we're probably in a seat where there's more of these hidden landmines now than normal or average.
But like you're saying too, like with a black swan, and you said the sneeze, or I think about like the camel that breaks the straw's back, it's usually due to some sort of leverage in the system that gets unwound. But it's hard to see where that leverage is. Like we're referencing, if you can't get good data, like we hear like, they're buying houses cash, but then like you said, if they refinance on the back end, that's not going into the data you receive. And there's always a granularity of data, or like a Hayekian problem where we can't exactly see. And they say the U.S. Consumer has their highest like savings in history, but it's like there's a lot of data that goes into, right, did it come out of a HELOC or something? Like, and to get speculative again, I'm just curious because I can't wrap my head around the amount of cash purchases is just mind-boggling to me, and I'm trying to find like better data on it because I can't understand it. And that's not pro or con, I just can't understand it. The second one I can't understand is almost like the Great Resignation. And so I started thinking about maybe like this $500 billion in equity refinances since COVID. Maybe that's helped where, you can, resign from your job, move into your parents' basement if they're willing to supply you with food, shelter, and clothing. And I don't want to be speculative. And I'm not saying pro or con. I just trying to, that's one I can't wrap my head around too, is kind of the Great Resignation. I'm just curious what your thoughts are.
The Great Resignation is way more boring. I don't understand why people don't. It's like basically post, great financial crisis. What was the stunning thing for central banks across the world? It was we have low unemployment rate, but yet wages don't go up because somehow we just keep finding, 200,000 people every month. And they were all mystified. They're like, where the heck are these people coming from? And the answer was simple. Like, it was old people. It was people that were told that they could retire. And then their asset portfolios went down 60%. And there are people living off those assets, so they don't get to just hold on and wait for the recovery, which obviously took several years. So they're liquidating every month and, 08, 09, 10, 11 to go ahead and live off of those assets. And they get to the point where like, shoot, I was told I had enough money to retire, but I definitely do not now. I need to go back to work. And so, that was filtering in those folks that were, we'll call it nicely in retirement. They were forced out of retirement due to the fall in asset prices. What happened post 2020 is literally the exact opposite. You had all these old folks that all of a sudden, holy cow, I was living in this thing that I bought in 2004 in the suburbs of Connecticut, and I was never going to be able to get out of this. And then all of a sudden, wham, like I just sold it for an actual positive return. I never thought that was ever going to be possible. This allows me to actually retire. Oh, my 401k is up 30-40% from where it was, December 2019. I now have enough assets to retire. And so all it was is we pulled a bunch of people out of retirement from a dramatically falling asset price market, and them actually needing to live off of them. So they're slowly liquidating to survive. And we now gave them an out. We gave them liquidity of their house that they never thought they would that was possible, along with obviously the retirement portfolio is healthy in comparison to what it was. And so now they can retire. And, the unwind of that is sadly, one of the potential hidden landmines out there is because the only reason they come back to the labor force, or likely to come back to the labor force, is if asset prices fall. So if asset prices are falling, well, that probably means that unemployment rates naturally rising because something is going on that's not great for the broader economy. And so you're going to have that, additional weight, if you will, of we naturally are going from a 3.5 to a 7% unemployment because something bad's happening. And then, oh shoot, now 5 million people just showed up too that we didn't expect anymore. So we've built a society with a lot of these rubber band issues, if you will.
Well, and part of that, once you get like the other it's always there's always broader aspects, right? There's so many variables, and one of the confounding variables I was trying to find good data on the other day, I couldn't, is our net immigration since COVID. It's obviously down, closing the borders, COVID, et cetera. So, and that's obviously accelerating a price wage spiral. But trying to find data on that once again is not good. And is that like you're saying that you have retirees that are fully retired, you have Central Americans and Mexicans not necessarily coming across the border anymore. All of that, creates constraints. And then, like you said, what happens if they all show up again? Then you've got now not only 5 million, maybe 10 million people looking for jobs. And what does that do on the price pressure? And I'm just curious, how do you see that reverting at all? I wonder, when I'm over on the East Coast, I talk to a lot of people that are, work 9-to-5 jobs, and they're talking about they're banding together because they want to, stay work from home. They want to go back in the office. And I can't help but think that if we do enter a recession and more people are looking for jobs, the first ones to get fired are probably work from home because you don't have to look at their face when you're firing them. But I don't know if you kind of have any thoughts on that.
Yeah, I mean, my I sound like grumpy old man,
exactly. Me too. That's true. We both.
I don't think work from home works very well if you're anything that's detail oriented, and when you're, we'll say, in this environment where you can't find any replacement folks, it kind of doesn't matter, right? You're going to be able to maintain that control to force the work from home, even if the performance is not going well. But as soon as there's either other bodies or you need less bodies for whatever's going on, those folks are probably the first out the door. I would agree.
And then part of what you referenced, and in both the Storm Provides and then you were actually talking about a little bit earlier is this idea of maybe with a 60-40 portfolio, stock bond correlations, and then how inflation is the compounding variable which may change those correlations where stock bonds kind of go in lockstep. And then we've actually kind of seen it a little bit year to date. And it's interesting, I think, for a lot of people to see a 60-40 portfolio be in larger drawdowns than just S&P 500, which is kind of doesn't happen very often. And we're in, one of the worst drawdowns in bond history, depending on which treasury, what tenor you pick. But I'm curious, like your thoughts. And part of that, and this is the worst. I'm going to ask a two-part question. Is that with the rising rate environment and like what you're referencing with people's houses and everything, and then we've seen retirees' portfolios skew more towards equities and bonds in the last several decades, especially target date funds. Does rising rates mean that they can start skewing back, and we see a rotation back to bonds because people are looking for income in their retirement years?
All right, so two-part question, as you said. So first off, we have a heavily financialized world. What that means is flows are dramatically more important than fundamentals. It's like, where you're finding your next buyer or seller is way more important than the liquidation value of whatever asset that you're talking about. And what that means in that world is that structuring is very important. Like how you're building some sort of structure to extract value and the flows generated from that structuring are incredibly important. And whenever you have structuring involved, that means there's financing involved. Everything is financed from something else, and that's part of the construct of how assets or frankly, people are building their household wealth. It's like the financing side is almost the most important lever within there. And what that ultimately means is that rates are embedded in everything. If why anything has value is how you created the correct structure and financing associated with that structure, it means when you get dramatic moves in the cost of financing, either cheaper or more expensive, both ways, that you should expect all assets to be highly correlated because the asset prices are there or are sitting where they are due to flows that are generated from how folks have created the best structure to finance access to those types of asset classes. So, ultimately, when you get to the, we'll call it far ends where you're really, really, really high rates or really, really low rates, financing becomes such an important factor into how everything is valued that everything should become very correlated. All asset prices should become very correlated. And so when you see dramatic moves, it should be not overly surprising that everything, moves in concession with each other. What was your second half of your question? Geez, now no, it's fine. Do we see a great rotation, almost German style, back to more bond-like income for retirees? No, that was a good question too. The answer is no. The number where people start caring is so far away from here that there's still no natural buyers of fixed income, right? And so you're like, well, we'll go institutional down to individual. So a corporate pension plan, right? They're now all pretty darn close to 100% funded. The average is above 100. Obviously, there's dispersion. But as a baseline, they're 100% funded. What does that mean? That means they've already locked down their liabilities. They're very boring. People like to talk about, pension stuff. Corporate pensions are doing very little rebalancing, everything, because they're already 100% funded. It's just locked down. They're trying to sell those liabilities to insurance company via pension risk transfer and be done with it, right? So they've already gotten small, but now that they're 100% funded, they're really boring. They don't contribute to much flows. They're already in the seat that they're in. You go down to public pensions. Public pensions have return bogeys of 7.5%, 8%, because it's the only way for them to optically look well-funded in comparison to what the reality is. And because of that, if they have return bogeys of 7.5%, 8%, do they care if treasuries are 1, 2, 3? No, they don't. When they get to 5, maybe 6, sure, that wakes them up. Okay, my actuary tells me that equities earn 8% a year, and I'm willing to go ahead and de-risk some of that into fixed income, but I need the absolute return that I could potentially receive for fixed income to be enough to go ahead and hit my return bogey of that 7.5, 8. So way, way, way far away before they become natural buyers. And you get to insurance. Insurance codes are set up for somewhere in the 4.5% to 5%, 5.5% zone is where their fixed liabilities sit. And so again, until they get to that type of potential absolute return, they don't really care. Like we're 150 basis points away in treasuries before they're going to become natural buyers. And then you get to an individual. An individual says, okay, obviously, I earned 0 on cash in my bank account. That's not great. But what's more important is they're thinking about how much more expensive is my lifestyle going to be going forward. And we're obviously getting inundated with the individual saying, holy cow, like, inflation 7, 8, 9%, it feels persistent. Like it's getting embedded in their brains that, I think over the long term, maybe 5% inflation is what we're going to see for the next 2, 3, 4 years. And if you're an individual that's thinking about fixed income, a distribution to support your lifestyle, and you think that your lifestyle is going to get 5% more expensive every single year, you sure as heck don't care about 3% 10 years. Again, you're not a buyer until you get to that, 5-6% zone. You get to there, sure, a bunch of people show up, but like that's far away. Like we're not anywhere close to that yet.
It makes me think, you were born and raised in Chicago. You rub shoulders with all those commodity trend followers, at the different, watering holes around Chicago. They've been obviously shooting the lights out for the last 6 to 9 months. But it's really interesting to me always, like, we're not hearing a lot of people ask about it or talk about it. And maybe like people think maybe, I don't know, it's transitory or they really are just performance chasing. They want to see like 2 to 3 years of those returns, or people are just hoping and praying that, inflation comes back down. I'm just curious your random thoughts on like commodity trend following in an inflationary environment.
No, I mean, in general, those types of folks do well during regime shifts, right? and we definitely finally had one of those regime shifts. I mean, it's kind of silly, right? Like we had the regime shift from low inflation to high inflation like 18 months ago, but it was only like 3 months ago that people started believing it, right? So it's like, again, flows over fundamentals, right? Fundamentally, right. It happened a long time ago, but it didn't start affecting asset prices until people finally committed to, oh, maybe we're wrong. So yeah, I mean, like I think they're probably in a good seat for the next half a decade, because it does feel like an environment we're going to have possibly several regime shifts that take place in a reasonably short period of time.
So going back to like the 60-40 discussion, at Convexitas, your actual expertise is, hedging with, tail risk solutions as overlays. And I'm curious that when you're having conversations with clients, do you even try to get them away from the bond exposure? Like we've tried in the past, maybe this is your new 60-40 or, ideally in 60-40, people have really just reduced their equity exposure because that's where the actual risk is. But sometimes if you have a tail solution overlay, now you can say, look, you can take much more equity exposure, but have that structural negative correlation. So I'm wondering if you're trying to talk them out of their bond exposure, or do you just kind of no, we'll overlay against your equity exposure?
So Jason, I mean, we don't hedge. That's not the purpose of us existing. Like we've created a tool to allow folks to rethink portfolio construction. And so that literally is our point is, why the heck are you relying on historical correlations to provide diversification for you within your portfolio? And when those traditional diversifiers are negative expected real returns, and pretty aggressively so. So now you got an asset that you're expecting to lose money on, and you're not very confident that it's actually going to provide any benefit. Why the heck do you own it? And the answer is we've all been trained that this is the portfolio that you should hold.
For 40 years, it's been a positive carry and negatively correlated for 40 years. So how do you talk them out of that?
Welcome in free lunch. Yeah. And so, it takes a while to retrain folks. But yeah, no, like the reason we built this business is the exact point is rethink portfolio construction, have all your assets in long-term expected positive real return allocations, whether it's PE, VC, equities, something along those lines, and allow us to become that diversification agent. And us as a diversification agent, we're not saying that we're, uncorrelated and, we're not relying upon assumptions in the correlation or basis risk arena. We're saying we are 100% negatively correlated to the S&P 500. And the point of us being involved in your portfolio is not hedge, dirty word that you said, Jason, or protection, or it's liquidity. It's the point of having any sort of diversification agent in your portfolio is to rebalance when things go haywire, right? I mean, if otherwise you should hold your nose and be the one that, just it has a max risk portfolio for 40 years, right? The point of having assets that move in different directions in your portfolio is for when those nasty event happens, you have liquidity to redeploy. And that is the ultimate enhancer of wealth over the long haul, is being able to buy a significant portion of your portfolio when prices are lower.
I was actually just thinking about that. A lot of times we talk about liquidity or inventorying risk, and I just thought about while you were talking. I was wondering, this might be a terrible analogy or metaphor, so you'll feel free to correct me. Is like your long GDP assets, right? Your long equities, VC, PE, is like running like just-in-time manufacturing, and then you're inventorying the tail risk solutions as for more of a robust resilience inventory. So you have the best of both worlds. Like you're running just in time, and then you're running a surplus of inventory when you're actually going to need it the most. Did I try too hard on that one?
No, I like it. No, it's like the old, or the other way to say is like you basically own the wings, right? You have a bunch of assets that perform well in good times, like really well in good times. And then you have, an allocation or a couple allocations that perform incredibly well in like the bad times. And, the whole world, I think, because basically demographics and where the wealth sits, has constructed strategies and allocations and the exact opposite. Nobody wants the wings, right? They're like, I'm retired and I got enough money and I just need distributions to go ahead and support my lifestyle. So that's the antithesis of the wings. Like we want very boring, right in the middle, regimented like returns. And so unsurprisingly, those are the worst assets to hold. If everybody wants, if flows matter more than fundamentals, and everybody wants that type of delivery of returns to their portfolio, those are probably the assets that are the most mispriced. And what's much more opportunistic is to create a portfolio that, in theory, is going to deliver that type of experience from like a realized volatility perspective. Like, we understand you're living off the assets, you're expecting distributions. That's A-okay. But we're saying the better way to construct that is to own the wings and have that ballast be liquidity providing when nasty events happen, but then have a portfolio that is expected to do incredibly well in all the other times.
And that's why, especially if you want to go hard into that right wing, is like the VC is an excellent example of that. But rarely do VCs pair it with the left tail. And you referenced several times like flows over fundamentals. Like if people are looking at fundamentals, they look at portfolio construction over years or multi-decade time horizons. A lot of these in vol space or option space, it's been, very interesting since the start of the pandemic. And so a lot goes on under the hood, especially on a daily basis even. And so we're talking about those flows. And you and I were texting on Monday, just for reference again, we're talking about Monday, April 18th, where at that close on Monday, there was just a vol smash at close that's much more of a flows basis and maybe structuring the players around that flow. So kind of like tell me kind of what you were thinking or saw. And we'll get into maybe the way that the news interprets that, maybe completely off base. But tell me about kind of just the structure of the vol smash going into close on Monday.
Yeah, no, to be reasonably boring, like a lot of people sell volatility, something that's benchmarked or looks very similar to the SIBO indices. And so you do the PUT index, for example. So all it is every expiration, you sell a new at-the-money put. So S&P 500, 4,400, you're going to sell, as of last Friday, April expiration, you're going to sell the May expiration 4,400 put, and then you're going to do it again the next month. Now, if you're doing that in actual SIBO product, the SPX product is cash settle. So it's kind of boring. Like you do it, you either made money or lost money the following month, and then you do it again. So mechanically, reasonably simple. And in theory about, how the averaging methodology works is we'll call it about 45 minutes after open on expiration. Everybody that's doing that type of mechanism goes and sells a bunch of new puts. So there's a little bit of a vol smash on expiration Friday, 45 minutes an hour after open. This type of, we'll call it, strategy has proliferated a much broader group in recent years. And again, it's driven by folks that are looking for income streams that look higher than, optically look higher, potentially are higher than the 2, 3, 4, 5% that they've been receiving in all traditional, we'll call it income-oriented assets over the last decade. And because of that, the folks' average allocation might be smaller, and or from a scale perspective, you want to be able to build your system to be able to handle accounts lower than several $1 million, right? Because again, if you sell an S&P 500 option contracts, one contract is whatever $448,000 notional, and so you're limiting the amount of players you can sell to if that's your denominator for going ahead and providing a product. So what you do the 10th the size product, and something people feel more comfortable, you sell puts in SPY instead of SPX or XSP. So that's 1/10 the size, and now you can do 40,000 increment allocations, which means now you can scatter it across the entire investable universe because it's sized appropriately to go down any stream. The difference between obviously SPX and SPY is one is cash settled and one is physical settled. So that means SPY, if it ends up in the money, you actually get delivered those shares or have to deliver shares depending on what side of you're on, but it's physical. You actually deliver something versus just ripping up the piece of paper. Somebody made money, somebody lost money, you get to move on. Last Friday, I think it's Thursday. Sorry, it was Good Friday. That's Thursday. What happened was you started the day with a, we'll call it 50-50 coin toss, whether those SPY puts were going to be in the money or not. They're right there at the open. But what happened throughout last Thursday, we sold off. So now everybody that's operating these strategies took delivery of those SPY shares. So now you were hired to go ahead and have an income-related type of product that's selling monthly puts as the driver of that quote unquote income. But now you own the SPY shares, and you got to get back to where you're supposed to go. So I mean, sometime on Monday, you need to sell all your SPY shares, and then you need to go ahead and sell a bunch of new puts. So what ends up happening is, because again, it's across so many different custodians and so many little accounts and all this kind of thing, you don't really get, we'll call it the VWAP effect. People don't really slowly do this throughout the day because operationally that's painful. The easier thing to do is to do it all at once. And along with that, the easier thing to do from a communication standpoint is to not do it at an arbitrary time during the day. Is to do it on close, because that way you have a reference point that everybody understands. You don't get chopped up if something happens between wherever you trade and the end of the day and have a poor communication or optics, if you will. So they all try to do it on close. So what you had throughout the day is, people figuring out how they're going to sell their SPY shares, making sure it settles, making sure there is, cash in the account. And then on close, or approximately on close on Monday, they went and sold all those new at the money SPY puts. So, as you say, how people interpret it, if you will. Yeah. I think some folks try to see these option flows and try to decide how they're influencing the direction of the S&P 500. I would argue that, more than 9 out of 10 times, the S&P 500 is an incredibly liquid, deep product. It takes a lot of flows to move it in any sort of substantial way. You're like, I'm moving things 10, 20 basis points at some random time frame. Sure, for sure. But it's hard to really peg that. And if you're trying to make 10 basis points on an expected move, they don't have the exact time, and a headline comes out and you move like 1% in the wrong direction, that eliminates a lot of the benefit of the ones that you thought you had edge in pretty quickly. But where it really shows up is in option pricing. So you go ahead and sell all these SPY puts on close. What happened? SPY volatility on the front end collapsed. It was a lot of folks selling vol, and that market is a lot thinner in terms of fair implied volatility. And those types of flows can actually move implied volatility, sometimes dramatically when they're this concentrated. But it has way more to do with changes in the vol service than it has anything to do with directionality in the market.
Yeah, I think about even like just basic punditry on financial news and even or on FinTwit is when they see that, whenever anybody sees that vol smash, they think it's a bullish sentiment for markets. And I'm just like maybe that's even part of it too. It's like the simplicity of that. And you're like, what are you even talking about? But that's what I always, it surprises me. But the other one, I'm curious your take. So any of us have traded commodities and everything with physical delivery. We learn to close out our contracts before we get into the physical delivery phase. So do you think this is kind of a new phenomenon, and then a new phenomenon in size because people want granularity? And then why are they taking the physical delivery? I mean, obviously it's not as difficult as getting physical commodities showing up at your door in, tanker loads or, rail card loads. But would it be easier for them to close it out, or do you think it's just as easier for them to do that on the Monday and just VWAP it at the end of the day?
Yeah, I mean, rolling options is probably more difficult operationally than selling an equity and selling a new option, to be frank, for most of these operational constructs. So I actually think what they're doing is probably technically operationally easier for them, even though optically it would appear to be the opposite of that. Along with the simple marketing pitch of, hey, this is what we do on expiration. We don't have discretion. We're delivering a formulaic return profile, and that's easier to do on a market determined time frame rather than something that a PM team ad hoc or something along those lines was constructing, because all it does is lead to questions like, well, this is the benchmark indice, does it on this day, why do you do it on a different day? And you're like, I'm trying to sell a 20 basis point product. Stop asking me questions. It is where it comes from. So it's the ease and distribution is a lot of where you end up where you are too.
So I'm sure you guys are tracking on a monthly basis. Is this something like you've seen the rise of, and so not necessarily concerning for you or not necessarily an alpha generator, but it's something where you have to just be cognizant of your book on these Mondays after expiration about how you're going to restructure or restrike your book? Is that basically the way you're looking at it?
Yeah, no, it's to be very aware that your expectation is Thursday, Friday, Monday around expiration, that shorter dated implied volatilities are likely to have some pressure. Like that's the extent of it. Like it's a potential known that you're aware of, and maybe you dance a little bit with your maturities to either avoid or take advantage of it, but not a straight up aggressive RV stance that you're trying to take. Now that CBO's all excited because of course the only thing an exchange cares about is more securities to trade. Now we got Mondays and Wednesdays and Fridays, and hey, now we're gonna have Tuesdays and Thursdays. I'm not saying like you do some sort of calendar wing trade where you're like you're buying the Thursday before, you're selling Friday and Monday, and then now you're buying the Tuesday or something along those lines. I don't think it's aggressive enough to fight through all that. But yeah, it's something to acknowledge and be aware of.
Yeah, I thought it was just more of that. Maybe Zed has an extra espresso on those Mondays after operations just to pay a little closer attention at the close. But then, you just referenced it. Now that they're rolling out like daily options, do you think that gives you a finer paintbrush, or you just think it's much ado about nothing?
I mean, ultimately, I think that if you were a high frequency market maker, there's probably some fun stuff to do, because the off, normal cycle tenors are probably going to have a bunch of really junky markets. and if you're the one that gets to sit out there and you have your machine, this is no human involvement, right? And you have the machine saying, okay, there's oddly like a 0.2 vol spread between Tuesday and Wednesday, like go ahead and make that market and try to collapse it. Like, yeah, there's probably something to do there. There's a reason why the prop shops around town over here always support the exchange new products, because that means, hey, this is new opportunity. But like,
and this exchange loves more volume as much as they can get.
That's right. So it's like, do I think somebody is going to be able to extract some edge? Yeah. I think it's people with $10 million a year tech budgets. It's not going to be me, but
exactly. And then you reference this as programmatic, which is, I think, a really nice way of putting it. The other way, like when people are trying to basically rebuild basic strategies, like you said, put or p-put index, and just rolling these structures. But like programmatic's one way of saying it. Another way is say it's actually a structure, not a strategy. So I'm not sure I necessarily have a question here, but it's like an open forum of like how you think about, people just rolling structures instead of actually having an active strategy, especially when you're trying to take advantage of structurally negatively correlated products to somebody's overall book.
Yeah, I mean, ultimately, I think the biggest transition, and everything goes in cycles, right? So we'll call 90s, 2000s was the decades of portfolio management teams. And then post the great financial crisis through at least now, we'll see how long it goes. It was the influence of distribution teams, right? And so, the market naturally goes through this cycle of, what's most important is alpha. And then, no, what's most important is scale. And we alternate, back and forth when alpha doesn't deliver and things blow up. Through those guys, let's focus on product. And when product creates a bunch of issues over the long haul, screw those guys, let's focus on alpha, right? And, with us being still in an environment where distribution is in the controlling seats of large firms rather than, we'll call it, traditional PM/investor types. I just don't think it matters. It's what is the easiest product or structure to go ahead and build and distribute, and if there's slippages, that's fine as long as they're not dramatic enough to make the product fail. And it takes a lot to make a product fail. Once a product has momentum and real assets, it takes a heck of a lot to disrail that momentum that it has.
And I can't help but banging my own drum here is also the idea, you referenced, of just what happens on Mondays that close after expiration or whatever, is vol surfaces are constantly changing and undulating. So to me, it's the last bastion of active management. Like you said, right now, people are looking for AUM and beta strategies, but I think it comes to roost eventually, right? That this is a place where you actually need active management, because vol surfaces and playing in the vol spaces with, options and derivatives is much more difficult than people realize.
Yeah, I mean, it's more difficult maybe, but like you said, at least there is an opportunity set that you can extract in a reasonably short time frame, right? If you're a fundamental stock picker, right? You might be right, but it might take 20 years to be right, and then it doesn't matter, right? At least because options, they expire. We have finite time frames of us trying to obtain value. It's an easier job from that aspect.
Yeah, or I think it's in a perverse way. It's the alpha is actually in diminishing the bleed, and then when shit does hit the fan, is how do you roll and protect it against the second leg down? So your two forms of alpha aren't really being seen too often, right? It's congratulations, you did your job. Well,
for a negatively correlated strategy, the most outperformance, if you will, that you're trying to achieve is during all those times when you're losing money.
Right, exactly.
So it's not exactly appreciated and easily acknowledged.
Yeah, you're I bled less than I should. It's not like a stab wound, it's more like a paper cut.
And I was only down 3.5. High five me.
Exactly. I'm gonna totally change tact on us. And I thought it was really interesting just recently, so serendipitously, your mother Cheryl was on the Growth from Failure podcast, and shout out to Yin Hin. It's a great podcast. But I'm really curious. I've always told you before, your age always surprises me. And I'm trying to think of the best way to say this. It's maturity or wisdom beyond your years. But I'm wondering if you have ever thought about, you were raised by, two parents, highly academic. Your mom has an unbelievable history, Fortune 500 companies. My mother doesn't quite have that academic background or the Fortune 500 background, but she's always been a bootstrapping entrepreneur. And I'm just wondering, how do you think that affected you being raised by, two people in the business sphere, highly educated? Does it create a different kind of educational background, which maybe makes us mature a little bit quicker than most? Or maybe I'm just being solipsistic.
Obviously having education be not only what you're, receiving at school, but pretty aggressively what you're receiving at home definitely helps you accelerate your learning curve just because you're doing it, 18 hours a day versus 8 hours a day. That's obviously helpful. And, the we'll call it, very fortunate part of the whole situation is twofold. When you see people succeed, it's easier to believe that you can succeed, right? That's in my experience, whenever we do my wife and I do some events around Chicago with kids, that's always the day that's most important to them is when you bring them into the city, into the office, and kind of do this can be you. And, they can see the big buildings from 3 miles away, but they've literally never been to the city. Like it seems like this walled off place that's not attainable to them. So, just having that ease of, success is achievable for you. Like, and you hear that and see that every day is huge. And then obviously very lucky that, having successful parents always allows you to have that psychological backstop of, if I fail, like I won't, be begging for money on the street. There's always a little bit of support there. So, there's obviously things that were good from we're going to help train you earlier in life with a bunch of skills that other people might not have. But then obviously the support aspect of you can really go for it and fail a bunch of times and take that risk where others can't, is probably the most beneficial thing. That's, too bad, because it's like, how do you bottle that and get that to more people? And
Exactly.
Not a hobby.
Well, I always like to think about it as like, yeah, kids watch what you do, not necessarily what you say. So if you have parents that are entrepreneurs or dealing with entrepreneurial struggles or business struggles, you learn a lot just by watching them, and not necessarily, what they tell you to do with your life. And also to clarify, it wasn't exactly, always up and to your right for your mom, right? There's always trials and tribulations. And in the end, it all kind of works out. But you did have that foundation with having both of your parents there. But I'm curious, like, if you ever really thought about when you have a mother that's such a high achiever, and or sometimes the breadwinner, or not quite the ultimate breadwinner in the family, but has those entrepreneurial and business tendencies. I hope that happens to more and more people moving forward, and it looks like it does. But I'm curious if you ever even thought about that and how it's structured the way you think about life.
Yeah, I mean, I at least hope that it foundationally makes me think of people based on what they can actually produce rather than anything else. I at least hope people think I treat folks reasonably, equally, and that means everything. And then what, honestly, through life, what that's ultimately resulted in me is probably conflict in the situations where I'm in larger institutions, because I tend to hold people above me very accountable for their actions, because I've seen like what good management and C-suite is, and can identify, I think, from a little bit of that experience, folks that maybe are not. And so I've always, I think, been somebody that has had probably additional conflict with senior folks, and hopefully folks that are up and comers felt like I was always willing to give them time and help them along their way, because you can't expect everybody to know everything, but you just need somebody that's hungry, and that's always exciting, right? Like those people you can work with all day long, and you'll figure it out, and whatever trials, tribulation, error, it doesn't matter as long as they're going to put forth that effort. But like when people are in the big buck seats and they do a crappy job, like I was always the person that was not afraid to call them out.
Well, and part of that, like your mom's focused on now, is also helping female C-suite executives and supporting them and helping them in their careers. And one of the takeaways I got from the Growth from Failure podcast was how much, for both of your parents, like their faith has informed their immense amount of charitable contributions they've done to the Chicago community. And I'm just curious, like how has that passed through to you, and seeing that as a child, and then thinking about it now with building a new family for yourself. Like how do you navigate that with the complexities of having a startup business, being a full-time trader, and then thinking about your contributions to the Chicago community at large?
Yeah, no, I mean, I'm a firm believer that it's very important to give. Money is helpful, but time is way more important. It's actually visiting. We do decent amount of stuff. We'll call it like elementary-ish age kids, and actually physically showing up, and just you're kind of performing a lesson, if you will, something along those lines. But ultimately, it's just a sounding board and trying to get them talking and thinking about aspirational things along those lines. So that's definitely been my wife and I's focus, is we'll call it younger kids, Chicagoland area, and really trying to give a little bit of our time to hopefully expand their experience horizon.
And then you and I text each other often. I think people would hopefully think it would be about derivatives, but most of the time it's actually about food. And because we both are deeply passionate about food in general. And what I found over the years is my cooking's become less and less, and it's more about the restaurants, and that's what we text each other about. Where you're nicely equally proportioned from going out to the best restaurants in Chicago, but also cooking a lot at home. And I'm just curious, because I always ask you how you navigate this with kids and especially a newborn. And then I'm thinking, when you're making your famous pasta sauce, are you as you're stirring the sauce, are you thinking about gamma, or how do you manage the complexities of that?
No, cooking is relaxing. It's not only fun, but it's kind of where I can zen out partially for a minute. And now it's great because my 3-year-old just obviously she wants to do everything that you're doing, but she loves cooking. So it's I give her with a plastic disposable knife. I'm like, all right, sous chef, cut up that tomato, and she's just over there pretending to hack away, and then we'll throw it all in there and all that kind of stuff. So it's a nice mix of true Zen time along with becoming more and more family time as the kids get older. So less market thoughts and more just empty space. That's my meditation.
Nice. I love it. So yeah, if we start talking about food, we're going to have to need an entire other episode. So I'll save that for another time, or maybe you and I should just start a food podcast, and maybe that'll be our claim to fame. And nobody cares about the trading side. They just want to hear us talk about food all day. I always like hearing your macro thoughts, and I think we've actually talked quite a bit about macro in the first maybe half of this conversation. And so I was almost going to give you the floor for macro, but I want to save that for maybe another time. But one thing, if I'm racking my brain, I'm not sure you and I have ever talked about crypto. So I'm just curious of what your general takes are on crypto, your hot takes of whether you hate it, you're interested, you're curious, that sort of thing.
No, I'm in the again, we'll sound like the old grizzled guy down the street of I don't get it. So it's the old I don't have anything against it, and I understand the business use case of the infrastructure that's being built. I'll never understand why the tokens have any value. That's my just don't get it. And it doesn't mean I have a strong opinion one way or the other of where anything's going. It's just I don't understand why these tokens should have any value in the long term. So I don't really get it. I do think from an investing standpoint broadly that the main crypto tokens, and we'll just say Bitcoin and Ethereum, are very useful metrics on general market liquidity. So I got that in my background, and plus minus 3% days, who that cares? But when there's serious moves, you're this might actually tell you a little bit of something. And I do think that there's more. I mean, it's the ultimate size is still too small to be truly market moving, right? In terms of total crypto assets. But I do think there's a lot of leverage in that space, so it doesn't take much to have it do little spillovers. I wouldn't necessarily say that I think crypto is going to directly influence the direction of the S&P or something along those lines, but I think it can have a little bit of spillover effects in specific publicly traded tech equities and things like that people are overly levered to on both sides. But no,
do you think do you think mainly in a liquidity cascade like March 2020 when we have a VAR shock, or do you think even if there were just something to happen with Tether and that base collateral gets repriced to 70%, it sets off a liquidity cascade on crypto, which then when everybody starts throwing out the baby with the bathwater can lead to that contagion, almost like you're saying with the sneeze earlier. We don't know where the black swan is going to kind of come from.
Yeah, I mean the entire crypto market is probably not big enough to really and it's probably not cross collateralized enough with other assets to be that trigger. But I do think it does give you a little bit of signal of risk on, risk off from a pure, is the faucet open or closing type of indication.
So with that small size, over 90% of crypto derivatives are traded outside the U.S. due to our regulations. So you're not necessarily chomping at the bit to allow you access to crypto's options and derivatives to be picking off retail clients, right? Because it's just the size is too small for you, or?
No, I mean, I obviously want to have a successful business, but I want to have a successful business for 10 years. And, picking up people off for 18 months is probably going to be hugely lucrative for certain folks, but definitely not the intended focus. Now, Devin and I, do we, bitch about it some random night of like, oh, this is so hard. Why don't we just do the easy thing? But, we tell ourselves in 5 years' time, doing the hard thing is going to be totally worth it.
Dude, and that is like, if people don't know, like, you guys do the hard thing. And I feel the same thing. Like, we try to do the hard thing, even though there is some nights, having a few drinks, you're like, why didn't we just do the easy thing? But like, something's wrong with all of us where we just like smashing our heads against the wall or something. And so we do the hard thing day in and day out. But I want to thank you for coming to the podcast. I always enjoy our conversations. I look forward to all our future conversations, especially all your text messages of what you're thinking about. But before we go, tell everybody where they can find you. What's the easiest place to locate you and Devin and Convexitas, or to read about your work?
Yeah, the easiest thing to do, just go to our website, www.convexitas.com. Pretty much nice little overview of who the heck we are. That's where we try to post everything, so we know who's looking at us. But yeah, that's the easiest way to find us.
And one of the best designed websites in the derivatives game. And just to clarify for everybody, convexitas.com. And like I said, you can read their writing, which he's not going to call an essay. He's just a thought experiment.
Nobody has time for more than 3 minutes. Gotta be quick.
Exactly. All right. Thanks, Zed. I appreciate it.
All right. Thanks so much, sir.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.